Welcome to Personal Pension Radio Podcast, where you get unconventional insights into retirement and lifestyle design that actually work. You don't have to settle for the same tired Wall Street advice. Break away from the herd and learn how to achieve the retirement lifestyle of your dreams. And now, here's your host, the income engineer, Kraig Strom.
Right, that is my cue to jump in. I'm Kraig Strom. Yes, I am the income engineer. You are on Personal Pension Radio. And I'm broadcasting from the Personal Pension Radio Workshop Studio here in sunny Southern California. Literally my actual workshop. The holiday season, Halloween coming up on Thanksgiving soon. Of course, then there's Christmas. So this is the time of year that I actually start getting excited about the holidays, at least from a crafty point of view. So I've started behind me here in my workshop my very first Christmas project, a Christmas gift project for a neighbor and for a very good friend. Her daughter has a need for something that I'm going to be building for them. So you are on Personal Pension Radio. Don't forget to check out personalpensionradio.com, where you can find all of the back episodes, plus show notes. I do my best to have show notes available, anything that I might reference that has a link, anything that you might want to double check. Now, if you don't find the show notes for the show you might be looking for, just go to Personal Pension Radio, contact me through the website. You can also find me online. Search Kraig with a K, K-R-A-I-G, Strom, S-T-R-O-M, and you can find me. Usually I'm on the first 6 pages of Google. If you search my name correctly, you'll find just about anything and everything you might want to know about me on Google. Thankfully, it's all good. So check that out. Now, if you're new to Personal Pension Radio, quickly, what is Personal Pension Radio all about? What am I about? The income engineer. What in the world does that mean? I am all about optimizing retirement income. Optimizing retirement income is a conversation that, unfortunately, the standard Wall Street financial advisory conversation does not cover the income side of the equation. A perfect example this weekend, actually, at my car show. Yes, for those of you who don't know, you're new to the show, I do a car show every Saturday here in my community. I started it a little over a year ago. I love cars. So the best way to have a great car collection is to have everybody bring their cars to my car show every Saturday. So I get some great friends, some really cool cars. But at my car show this weekend, I actually was talking to one of the people who had attended the show. It's been a while since he was back. We got into a conversation somehow about retirement. Retirement income came up. Actually, I brought up retirement income because he had offered up the fact that he was working with a fairly well-known financial advisory firm and that he had expressed some serious concerns about his account. And I mentioned a couple of things that are related to my specialty in retirement income planning. Now, I must say, personally, I'm pretty darn good at the accumulation conversation, investments, and all of the things that go into saving for retirement and accumulating assets and wealth. But my real passion is how to blend all of that together into a well-balanced, maximized retirement income plan. So I mentioned to this gentleman, I actually asked a question. I said, so how have you dealt with sequence risk? How have you dealt with the sequence risk associated with your portfolio? He looked at me like most people do. He had no idea what I was talking about. I said, so tell me about the Monte Carlo simulations that you've run on your investment portfolio. And he said, on my investment portfolio, well, I used to work in the engineering and aerospace field, and we ran Monte Carlo simulations on the projects that we did. But I don't know about a Monte Carlo simulation with my investments. So right away, I knew that this person had never met with a financial advisor that truly understood retirement income planning. And yet here he was, fully engaged in retirement, and did not have a financial advisor talking to him about the rules of retirement income. Wow, that's scary stuff, but unfortunately, that's exactly what I learned when I came up as a financial advisor. So about 19 years ago now, I was educated by the Wall Street financial advisory machine, and I was never taught to pay attention to the retirement income side of the conversation. I was taught the same answer that to everything, basically. The answer was invest more, invest. I was taught diversification and dollar cost averaging, et cetera, et cetera, et cetera. The reality is there's a whole different side of economic rules and principles, if you will, for retirement income planning. And given that most advisors today have been educated by the same machine that taught me the messaging that worked at the time, as I'm going to say my opinion, the messaging worked best for banks and Wall Street, right? CPAs, attorneys, bankers, insurance professionals, and the list goes on and on and on. The advice is always the same. It's incomplete. It is not the full retirement income picture. Okay, so this show, my passion, is optimizing retirement income. And I'm here to tell you, it does not happen with a product. So mutual funds, variable annuities, real estate, life insurance, annuities, stocks, bonds, none of these things by themselves will help you optimize retirement income. It just won't happen. Now, on the other hand, you put a plan in motion that you accumulate wealth in the form of real estate with a long-term plan to convert some of that real estate to annuity income, where there's no market risk from real estate, where there's no tenants, toilets, trash, and taxes. Okay, the 4 T's of real estate: tenants, toilets, trash, and taxes. Sorry, I was getting off track there. But back it up a second, right? Remember, there's no one product that will fix and maximize retirement income. So using real estate as an example, it happened recently, right, that I was talking to someone that wants to invest in real estate. And I said, well, that's great. What's your plan for the real estate? Oh, we're going to pay it all off. We're going to pay it off. We're going to have no mortgage on the real estate. And when we did the math on the paid off houses, multiple rental properties in retirement, with the taxes, the toilets, the trash, the expenses that go with it, okay, they were going to have, maybe if they were lucky, a net income of 4%, maybe 4.5%. That's a net income if they don't have any catastrophic problems with one or two of their rentals. So as a retirement income vehicle, their real estate was not necessarily that exciting. It was actually kind of risky. At least this is the real estate that they wanted to build a portfolio. On the other hand, if you partnered the accumulation and growth of real estate with a plan in the future to use an income annuity. Now, these are essentially personal pensions that you can buy from a life insurance company. So if you partner real estate as an excellent accumulation vehicle, but it's kind of a risky income vehicle in retirement, but if you convert that and you have a plan to convert that awesome accumulation asset into an awesome income asset, right? The income annuity can provide, depending on your age, sometimes as much as 6, 7, 8% guaranteed draw income rate. Well, that's a huge benefit, and you eliminate the taxes, toilets, trash, and tenants problem. And now we have an awesome income asset. Okay? So optimizing retirement income does not happen with a product. It doesn't happen with these things by themselves. You've got to have a balanced approach. You have to look at everything and find out what is the appropriate balance of all of these different things together to get you to that maximum income number. Okay? So that's what it's all about. Now, disclosure, before I forget. I am not an attorney. I am not a CPA. I am a certified financial planner professional. But please, as good as I think I am, please do not act on things that you hear on this show as if you've received advice. Okay, please don't act on things you hear from financial entertainers especially. Oh my gosh. Financial entertainers just drive me nuts. These are people who give out financial advice on 30-second sound bites, and they're not licensed to be financial planners. They're not licensed at all. They have no regulatory oversight, no one double-checking to make sure they're giving good information. And it's especially important that you don't act on things that you hear from financial entertainers, let alone a certified financial planner professional like myself, because you really need it. You need to owe it to yourself. You really owe it to yourself to meet with a qualified financial advisor. That's how you're going to be able to get the information you need, okay? And I want to be able to say meet with a certified financial planner, because a certified financial planner has usually just gone that extra mile to really just hone their skills and get educated and just to achieve that pinnacle of financial designations. And yet, recently I had an experience with someone asking me about a certified financial planning professional that recommended they put all of their retirement assets into one financial product. Just drives me nuts. I will be reaching out to that person, and I'll probably be sharing some of that story with you on a future episode. But please remember, if you're going to meet with someone, meet with a qualified financial advisor. And if you have any questions about the advice you're being given, any questions about a product, about a strategy, and you'd like just to have a double check, maybe even you think you've got something that might be a topic that I could cover on the podcast, give me a call. Go to Personal Pension Radio, check in with me. I'd be happy to review it with you and just to make sure that you're on the right track. All right. Now, the first segment, what I want to cover today, caught my eye. This was actually something that caught my eye because of a conversation I was having with someone related to the state in which I live and the taxes that we pay. So this is a Kiplinger article that was just titled "The 10 Least Tax-Friendly States." The 10 least tax-friendly states. So I was actually surprised that my state, California, was actually number 6 on the list. I thought for sure California in this list would be higher on the list. Well, as it turns out, the state of Vermont is, according to Kiplinger, the worst tax state to retire in. So you have to understand, I'm going to give you links in the show notes to this so you can check it out. But as I read through this, the tax rate in Vermont compared to California, in some respects was harsh, but their real harsh tax rate is on the very high income earners, really high, like $400,000 income. Now, if you're in Connecticut, your real estate taxes are the 4th highest in the nation. Pretty hardcore. Then Minnesota, number 3. Oregon. Oregon has actually got a harsh income tax. I think Oregon, for me personally, when you think about retirement, it's retirement income, it's pensions and so forth. Well, the state income tax in Oregon on $125,000 income for a single person or $250,000 for a married couple, it can go as high as 10%. That's a pretty heavy income tax in Oregon, of all places. Montana's in there. Montana considered high income, or at least the upper threshold of their income. Montana came in at number 5. They had their upper threshold of income for their highest tax rate. You ready for this? At the huge, glamorous $17,400 per year. So if you got $17,400 per year coming in, you're at their highest income tax rate. Now, they don't have a sales tax, right? So if there's no sales tax and you're just getting hit on income taxes, there's an argument for having non-taxable income perhaps, right? Now, my state, California, comes in at number six on the list. The state income tax in California, just so you know, goes up to as high as 13.3%. Now, that's very high income earners, but still, the fact that there's a 13% bracket in the state of California is extreme. Now, sales tax. Sales tax is where they get us here in the state of California. Sales tax, when you add in the county local taxes plus the state taxes, we run as high as 10%. Guess what? Congratulations. We have the highest sales taxes in the country. Number 7 on the list is Nebraska, of all places. 8 is New Jersey. New Jersey holds down the fort with the highest property taxes in the U.S., according to Kiplinger, followed right in there behind with New York. And then one that caught me off guard here, I didn't realize that Utah would be on the list in the top 10 least tax-friendly states to retire in. Utah. And yet Utah has a flat tax on income. They have a flat income tax of 5%. And here's the part that, again, I don't understand how they rate these things, because when I look at retirement and taxes, I'm looking at it from a big picture. Like, what's the estate tax? What's the inheritance tax? What do those taxes look like? Well, in Utah, there are no estate taxes and there are no inheritance taxes, and you got a simple flat 5% income tax. It's pretty simple to manage, right? Now, let's go on. There's another one here under the Watch Your Step segment, and this is the one that I'm going to try and maintain my temper. How's that? I get really excited when I go through these things because I don't understand how they let these people write articles. I understand that there's a 24/7 news cycle. I understand we need content, but some of these writers, it's incredible. I just don't understand how these folks get published. This is amazing. So this is another one of those items that's going to be in the show notes. So definitely take a look at it if you'd like to see where this article came from. You can go right to the Daily Herald and you can click on the link and you can see it there. But let me go through it. So here is the title that caught my eye. Calculating retirement income is easier than you think. Really? Okay, you've got my interest. I was hooked. Let's take a look. Let's go through this. Now, the author actually says, and he says this and just, if we didn't try so hard, retirement planning would be easier. Au contraire, my fine author. People aren't trying hard enough. That's the problem. People are not paying attention to the retirement income problem. So the author goes on to say, perhaps better is the enemy of good. Maybe we should just consider the notion that a simple solution is the best solution. Okay. All right, here we go. So he's got me hooked enough. And then he says, it can answer the 2 questions that vex people the most. Okay, all right. What are the 2 questions that vex you the most? Number 1, how much can I spend from retirement investments and maintain my purchasing power? And the second question that vexes people the most, will I run out of money before I die? Those are the 2 questions. And the answers to these 2 questions are easy. 2 simple tools. So this is where I actually said out loud as I'm researching for today's podcast. That's where I said out loud, this is going to be good. All right. 2 simple tools. What are they? What could they be that makes retirement income planning so simple? You ready? Here we go. Number 1, use a simple index fund portfolio. Now, for those of you who don't know what that means, an indexed fund is essentially referencing a mutual fund portfolio, a mutual fund that tracks a certain index, like the S&P 500 index or the NASDAQ index or small cap index. So the answer is two simple tools, and the one is to use a simple index fund portfolio, and the second tool, I'm glad I was standing up when I read this because I would have fallen out of my chair. The second tool is follow the IRS RMD tables, required minimum distribution tables. Oh my gosh, I have never heard something so lame. This is the plan to make retirement income simple. So let's keep going. All right, calm down. That's when we get to this next section that says use the portfolio visualizer tool. Portfolio visualizer tool. Wow. What is that? What's a portfolio visualizer tool? I was intrigued, of course, so I clicked on it, and the link is in the show notes. So you can go do it yourself. The link is in the show notes, and essentially what it is, drum roll please. No drum roll. It's a Monte Carlo simulation. It's a Monte Carlo simulator. It's a calculator that you can find at portfoliovisualizer.com. And here are the lessons learned, right? This is what the author of this article says are the lessons learned. Number 1, you won't run out of money. You may have less than you started with, but since you are taking a percentage of your account, it is impossible to run out of money. Did he say that your income would remain stable and consistent? Did he say that you would have the lifestyle that you hope for? Did he say that? No, he didn't say any of that stuff. Basically just said you won't run out of money. Didn't say that your income would be what you hoped or dreamed it would be, right? Lesson 2, your income is pretty nice. Seriously? Here we go. You ready? Okay, what's a pretty nice income to you? Think about it. Visualize it in your head right now. What's a pretty nice income in your world? If you were to project out, just seriously, close your eyes for a quick sec and think forward, retirement income. What's a pretty nice income? All right, here's what the author says a pretty nice income is. Between $36,000 and $46,000 a year. Here's the fun one. If things go well. This is based on $1 million, by the way. Based on $1 million that he did his article on, and he did his portfolio visualizer tool on. Your income is pretty nice, really. $36,000 to $46,000 a year as a millionaire. That's nice. Thank you so much for this rich retirement lifestyle that we've always dreamed of, right? Okay. Sorry, this is what I promise. I got to calm down now, Kraig. The income engineer is starting to steam. Lesson number 3, your purchasing power would rise for 23 years and reach as high as $56,000. Your purchasing power would reach over 23 years. You would eventually reach maybe $56,000. Wow. Lesson number 4, your long-term income isn't bad either, Not bad. That even if you were in the bottom 25% of all the scenarios that they tested, your income would be up to $45,000 when you got to age 100. Are you catching this, right? Okay, let me just finish. I'm just going to jump to the end because it just drove me nuts. This kind of stuff is what you out there in my listening audience, this is the kind of stuff that is all around you right now, that 24/7 news cycle, they are constantly looking for just stuff to fill the space. And unfortunately, the editors clearly are not paying attention. This is garbage. Hello to the Daily Herald. The Daily Herald out there, this is garbage. It's amazing that you would even publish this kind of stuff. So I went to the same Monte Carlo simulation just so they know. And I ran the simulator just to see what the simulator would look like. And I'll tell you what, it came up with an 80% success rate, meaning that I had a 20% chance of failure if I used the Monte Carlo simulation. And if my wife or myself lived to be 95 years old, we had about a 20% chance that our plan would blow up. Okay? And we got to live on a horrible, kind of a depressing lifestyle income to begin with. Remember, 25% of the time, in this guy's example, the results are worse. 25% of the time, the results that he quotes were the worst. So, would you? I've asked this question of the listeners before. If you knew as you got on a plane, let's use my plane from California to New York. We're going to get on a plane and we're going to head off to New York. All right. Now, if the pilot came on the microphone there over the public announcement system in the plane and said, "Hey, everybody, we've getting ready to close the doors. We got about 5-10 minutes before we're ready to get out of here. We have run about 10,000 different calculations on our trip today, and if we figured that we have an 80% chance of making it all the way to New York. Buckle up and we'll get ready to leave anytime now." Now stop. How many people want to get off the plane? There's a 20% chance that the plane will not make it to New York. How many people want to get off that plane? I'm pretty sure it's everybody. Now, to be clear, did I say the plane was going to crash? No. Did I say that there's a 20% chance that the plane might not make it all the way to New York? What if you end up landing in Nebraska, one of the top 10 worst places to retire for tax purposes, right? You just don't want to be on a plane that has a 20% chance that you won't make it to your destination, right? The Monte Carlo simulation is the go-to standard for retirement income conversations, and it has been for 30 plus years. This is what I was taught when I was coming up as a financial advisor. And I'm here to tell you that it doesn't work anymore. It doesn't work. It's not the way to get the retirement lifestyle that you might hope for, okay? So if you have never had a conversation with your financial advisor about the Monte Carlo simulation, number one, why? Why haven't they brought it up? Go to your financial advisor immediately. Ask, what's my retirement income going to look like if everything works out perfectly? And then, how did they come to that retirement income estimate that they're giving you? Did they run a Monte Carlo simulation? Did they use more than 4% income in their Monte Carlo simulation, right? If you are speaking with a financial advisor that is referencing the 4% rule, Monte Carlo simulation, things like that, then I'm going to suggest that you are not working with a retirement income specialist. You have got to find out what your retirement income looks like with a retirement income specialist. I happen to be one. That's me. Go to Personal Pension Radio, request your own income analysis. I'll let you know what your retirement income projection looks like based on the standard Wall Street path, the Monte Carlo path, and I'll let you know what it looks like on a balanced, integrated approach so that you can see whether or not your income could be hugely better or not. Okay? Now, let's finish up here. Had a couple of listener questions come in. Number one, listener asked, "Hey, how's your car dealership going? Haven't heard about your car dealership in a while. Have you sold any cars?" Well, no. Those of you might have listened a few episodes back. Myself and a friend, we started a car dealership. So we actually are licensed in the state of California as car dealers, so we can buy and sell cars at the auctions and so forth. Now, we set this up and purchased cars initially because we want to enjoy the cars for a while. So selling them fast was not the initial goal. Now, the price reductions, that phase where we are reducing the prices and getting them ready to sell, That's actually happening right now. So we are dropping the price and getting the advertisements out there and getting ready to really move these. So we'll sell the 3 cars that we have, and we've had a real fun time with the cars that we purchased. And if you ever want to see the cars, you can find them at CaliforniaHighlines.com. CaliforniaHighlines.com. We've got 3 nice cars, and we'll get those sold, and we'll buy 2 or 3 more. So we're having a blast, and I will keep you posted on it. Okay. Now, this question came in from a listener. Here's what they said. It said, "Hi, Kraig. I am about to retire from the fire department, and my wife and I are concerned about taxes. We will be getting a very good pension, and we also saved money in my 457 at work." For those of you who don't know, a 457 plan is essentially a 401k for government workers. Okay, so this person has a very good pension, and they also saved money in a 457 plan. Now, we have a small mortgage on our home, and our kids are almost done with college. My accountant says that we are probably going to be in a higher tax bracket when we retire. We have 2 questions. What should we do with my 457 account? And is there any way to lower our income taxes? Now, those questions may seem simple, but unlike a financial entertainer, I did not plan to answer those questions until I spoke with this couple to get some more detail. So I was able to get in touch with these folks, had a much more in-depth conversation, asked a bunch of questions. Okay, so now, here's the thing. As it turns out, the pension income that he stands to receive from the great state of California is ridiculously large. It's an excellent pension, and he will be in a nice high tax bracket because it's all taxable income in the state of California. So, good news. Now, here's the problem. He also did what financial people told him to do, which you got to put money in your 457 plan, which is like a 401k. Well, with the pension that he's going to receive, he does not need the 457 money today, tomorrow. Highly unlikely that he's going to ever need the 457 money, and yet he's going to be forced to take money out of that account in the future, and he'll be forced to add that into his taxable income. And it's really unfortunate because he'll be in a very high tax bracket. Okay. So I dug in a little deeper because his question was, what do we do with the 457 plan? And is there a way to lower the income taxes? Well, one of the big things that comes to mind for them is, would it be possible to roll the 457 plan into more of a Roth IRA, pay the taxes today, and then in the future, let it grow and then take the money out in the future where it is tax-free, where it's not taxable. Okay. How do we do that without really going crazy on his taxable income? Well, as it turns out, he has a couple of hobbies. He loves surfing and he loves fishing. He loves freshwater fishing. He loves saltwater fishing. He loves fishing. Now, he's looking forward even to having time to make his own surfboard. He wants to make surfboards. Let me clarify. He loves to make these things. He makes really nice surfboards when he has time to actually make them. Now that he'll be retired, he'll have time to do that. He also dreams of traveling to Alaska for fishing trips. So here's what I did. I asked a few questions. Questions. Remember, here's my first question. I said, do any of your buddies like to surf? The answer, of course, yes. Yeah, I have several buddies who love to surf. I said, do you know anybody who would like to have a custom-made surfboard with hand-laid wood inlays? He said, sure, I know. I've got a few guys that would be interested in that for sure. I said, okay, sounds like you've got yourself a surfboard business. Sounds like you've got a business here that you could actually make surfboards, custom ordered surfboards for people. And don't you also have to take those surfboards to the waves and test them and shape them and test things out, right? You've got to test those things, right? Yeah, sure. And I said, well, I think you just discovered a startup business making custom surfboards. And I believe if we talk to your accountant, you'll find out that travel to the beach and travel to the waves and travel to the Home Depot and the stores to purchase your supplies just became a business startup expense. And you could just see, you could hear in his voice, like, wow, he'd never thought of that. My next question, any of your buddies in the fire department like to fish? Oh, anybody that you know who would be thrilled to have you as a guide in Alaska? Because he's been to Alaska several times. And he said, yes, absolutely. I've already got a bunch of guys that want to know when my first trip to Alaska is going to be. They want to go with me. I said, do you realize how much people pay for guided fishing trips to Alaska? He said, yes, I do. I've actually done it. I said, so you could arrange and guide a group of guys to Alaska, couldn't you? Yeah, absolutely. And I said, well, you just got a startup business as a fishing guide. You got to have a real business intent. Now, I'm not just throwing this advice out just so you can get a tax deduction, because here's a big problem that comes with these business startups is that all of a sudden you might actually start making money making surfboards. You might start making money taking people on fishing trips. And then you've got yourself a new job. Now, the new job might be a job that you love because it's your hobby that you are passionate about. You love to fish. You love to surf. And that's a fantastic way to make money. And yet you have to keep in mind, you might end up in a situation where you've got taxable income. But in the beginning, you're going to have business startup expenses. You've got a tax deductible hobby. Okay? So I've already talked to this couple. We're going to get back together, and we're actually going to have a conversation with their accountant. I'm sure the accountant is going to be excited to help them arrange things and record things and document things just the way it should be, so he can legitimately have a tax-deductible business startup. And here's the fun part. If you have that tax-deductible business, could you use some of that startup tax offset to pull some of the money out of the 457 account to get that into a long-term tax-free position like a Roth or some other type of an account that would grow tax-deferred, right? So you can use those things together to open up tax deductions and tax incentives that he'd otherwise would have ignored. Now, great question, by the way. That took a lot of work just to make sure that I answered that. There's a lot more, by the way, in detail in the answer to this, but I want to keep it simple for the podcast. Just know that that's an outstanding question. I'm so glad you sent it in. Please keep the questions coming. You can go to personalpensionradio.com, contact me there, and happy to help. Now, remember, please, the future belongs to the people who take action today. Seriously, take action today. I was looking at a little ceramic statue that I have, or a little ceramic thing that I have in my office the other day. It is actually 4 frogs on a log. And it goes with this riddle that I'd heard years ago. 4 frogs on a log, 3 of them decide to jump. How many frogs are left? 4 frogs on a log, 3 of them decide to jump. How many frogs are left? Well, the answer is all of the frogs are still there, because those 3 frogs, they only decided to jump. I didn't say they actually did. When I heard that, I actually went out to eBay and I found, sure enough, 4 frogs on a log in this beautiful little ceramic sculpture, and I've had that in my office ever since. It's a great reminder, and I want to share that with you today. The future belongs to those who take action. Jump off that log, go to Personal Pension Radio, contact me right there, ask for your own retirement income analysis. I do a detailed retirement income analysis and a conversation that you have probably never had with your financial advisor, and you will love it. Once you know where you're headed, you can find out what it takes to change the course. Until you know where you're headed, you have no idea whether it's good or bad. Let me help you find that. Take action today. Thanks again for being here on Personal Pension Radio. I'll talk to you again real soon.
Thank you for listening to the Personal Pension Radio podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.